All right, for a second time, thanks so much everyone for joining, both in person and online. For folks online, I'm not sure how much of that you could hear, but even amongst the experts, there are so many challenges with ICTs. Thankfully, small-scale farmers are just as, if not way more resilient than we are. We figured it out. This session ends at 2:30, so I will do my best to leave time for discussion. I think now potentially hold larger questions for the end, just to make sure I have the slides on innovation and following the rules and sticking with the theme at the end of the presentation. So I'll hold larger questions to end so I can get to those. For folks online, my colleagues Emily Sylvia and Leonie Rouse are joining. So as I mentioned to folks in the room, put all of your questions, your hard, tricky questions in the chat for them. Save the softballs for me. Any clarifications and resources they're also able to share as well. But today we'll be chatting about protecting farmers from weather-based risk, and specifically in evidence review of indexed insurance, as well as looking at innovations and future directions. Joined by many experts in the room, including a researcher who will be presenting on your ongoing project on indexed insurance. So hopefully we can have time for a great conversation at the end. I'm not sure if I've reintroduced myself yet, but I'm Sarah Coughlin. I'm a Senior Policy Associate at JPAL. And I will first start by quickly walking through what JPAL is and who we are before diving into the evidence today. So JPAL is a research center. We're headquartered at MIT with regional offices around the world. And our mission, broadly speaking, is to reduce poverty by ensuring that policy is informed by scientific evidence. And we do this through research, policy outreach, and training. Decades of research show that there are many complex drivers of poverty. Everyone in the room is familiar with this. And at JPAL, we support rigorous impact evaluation to shed light on this complexity. Does it seem like we're good online so far? Thanks for Go ahead. All right. So we take a scientific approach to innovate, test, and scale up solutions. Again, as folks in the room are familiar, the livelihoods of the majority of the world's poor, 80% or more, depend on agriculture. And so understanding challenges and potential solutions in this area is an important part of the puzzle. And so our network of affiliated researchers try to understand the conditions and causes of poverty and of agricultural challenges to tailor and scale up evidence-based solutions to tackle these problems. So by using the creative potential of our researchers, innovating on social programs, and testing and improving on them, we help governments, donors, and NGOs be more effective in the work that they're already doing to help improve the lives of millions of people. And so while there are many ways to evaluate the impacts of a program, JPAL specializes in evaluating them using randomized evaluations, or RCTs. I'm seeing some nods, and I know many of you in the room are familiar with this, but we are fortunate to be joined by folks from a wide array of backgrounds today. So I will take a moment to walk us through the intuition behind RCTs, as this is where the evidence that I'll be speaking to today comes from. So for example, say you're an NGO trying to decide on a program to improve crop yields, and you want to see if an input loan program is going to be effective in a particular region. So thinking that each icon here represents a farmer, there's going to be variations, both visible and unobserved, in the characteristics of each farmer. We'll imagine that the farmers in the darker orange color here might have access to more resources. Maybe they're more connected to their local extension agency, or they had a good harvest last year and have more cash on hand at the beginning of the season. Or maybe there's an unobservable characteristic like soil quality that we can't see. We want to understand whether the input loan program had an impact on their yields at the end of the season, or whether there were some other factors at play, potentially one of the ones I just described, that sort of created this impact. And so in an ideal world, we'd give the program to a group of farmers, see how their yields changed, and then go back in time and measure the yields they would have had in a world where they hadn't received the program. So I'm describing the counterfactual here. Of course, even with all of our advances in technology that we heard about this morning, we can't do that. And so instead, we can achieve a similar goal by randomly assigning individuals to either receive the program, so the intervention group here, or not receive the program, the comparison group. Because the only systematic difference between the two groups is the presence of the program, we can confidently attribute the difference in outcomes between the two groups to the intervention. In other words, this randomization process has allowed for a causal interpretation of the difference between the intervention and the comparison groups. Of course, this is a simplification, but that's the intuition behind it. And it's for this reason, this causal interpretation, that's why at JPAL we choose to focus on RCTs. And while they have become a widely used methodology, RCTs are, of course, not the only way to learn or the only impact evaluation strategy that can generate useful lessons for policymakers and implementing organizations. They do require a lot of coordination between implementers and researchers. Francisco and I were just having a conversation about some of the challenges about that. But they do in economics help us to understand in particular the role of behaviors and institutions in program and policy outcomes. So the evidence base that I'll be talking about today primarily comes from RCTs. And at JPAL, move briefly here, we connect the dots from results of RCT research to policy outcomes. We have 900 affiliated researchers at universities worldwide, and we work alongside them to fund and help manage randomized evaluations in 11 sectors. Of course, I work and we're focusing on agriculture today. And we provide guidance, outreach, and support to NGOs, governments, foundations, and other partners who are seeking to make their programs evidence-based and as effective as possible. And we also provide formal trainings, etc. I'll note, just to contextualize a bit, we're talking about agriculture, but we also work in all of these overlapping sectors and grounded by our network of academic researchers around the world from leading universities such as these. And this network of researchers has carried out more than 1,000 randomized evaluations in countries around the world. So we benefit from global knowledge as well as local grounding. In addition to our offices in Cambridge, where I'm based at, JPAL has offices in Latin America, Europe, Africa, and the MENA region, as well as South Asia and Southeast Asia. So we benefit from seeing the bigger picture by synthesizing learnings across this vast body of research, finding cross-cutting themes, pulling out some of the policy lessons that I'll be talking about today to inform future programs and policies. And with that overview, I'm going to dive into what you've been waiting for on weather-based risk for farmers, sort of the evidence review of index insurance before moving into some innovations and future directions. Okay. So for most folks in the room today, a driving mission of our work is to, in some form, support small-scale farmers to boost their productivity and profits, lift living standards, realize long-term gains in welfare. Broadly speaking, one major stepping stone towards this pathway, is for farmers to shift their production practices and to invest in productive agricultural technologies like appropriate fertilizer use, improved or hybrid seeds, relying on mechanization rather than hand labor, and modern post-harvest handling and storage practices. So what researchers in our network at JPAL do is to evaluate the design, uptake, and success or not of these technologies on farmers' profitability, profits, yields, related outcomes, to tease out the constraints that farmers face in adopting them. So in other words, trying to understand the behavioral or institutional barriers in place that prevent farmers from being able to shift their production to be more profitable. And so on the screen here are some of the ways in which we categorize these constraints into several buckets. There are more like gender-based barriers, but as particularly these top four are on the screen are what we have larger bodies of evidence on. So credit and savings, risk obviously, access to information and extension services, as well as a growing body on input and output markets that I think I heard as a larger theme and trend in the conversation this morning. And we think that, I'll note, research has shown that unlocking or alleviating one constraint can lead to small increases in productivity. We think that for sort of long-term transformational change, it's important to generate more research on alleviating multiple constraints at once, so bundling services together. And we'll touch on that a little bit, but I think that's an important area of study, and one that one of our newer initiatives, the Digital Agricultural Innovations and Services Initiative, or DAISY, we're about the fun acronyms here, is focused on digital solutions that are looking at bundled constraints. And Francisco is a perfect person to chat more about after that, as his project is looking at input markets and access to digital extension. So in particular, how does weather risk constrain technology adoption? I think we could all give a quick one-sentence overview of this. Obviously, floods, droughts, heat waves, cold spells, irregular seasons, or unpredictable temperatures, they're all large sources of unpredictability that may cause farmers to lose large portions of their harvest. But they're also really increasing in likelihood and severity due to climate change and becoming more unpredictable over time. I'll call it a couple sort of specific factors that make weather risk unique. One, looking specifically at sub-Saharan Africa, a driving factor of weather-based risk is that about 95% of agricultural land is rain-fed as opposed to irrigated. So it's by far the lowest irrigation development rate of any region of the world. It means that farmers are really exposed to variations from rainfall, making them particularly vulnerable. And a key feature of weather risk is that they're aggregate. So a drought or flood is, to some varying degree, going to impact all farmers within a geographic area. And because of this, it's not easily addressable by the informal risk pooling arrangements that are common in many low and middle income countries. So if you think about like a joint microcredit group, if one person in that group loses out because of a drought, it's very likely everyone else is able to as well, or is going to as well. So the group's losses won't be covered. Everyone's going to be out of money. And then an additional feature is that, sort of compounding this, weather events will lead to heat or water stressed crops, for example, just less healthy plants that are more likely to then succumb to pest or disease. Or, if soil is overly wet, there's more likely to be rot or fungus. So there's a sort of secondary risk of pest and disease loss. And what this all means, putting it together, is that without any way to mitigate or ensure risks, particularly in environments where there aren't, governments with large social safety nets, etc., investments in crops or technologies made at the beginning of the season seem like an unsafe gamble because farmers can't be confident that they're going to make back their investments. And we think that farmers, particularly those with more limited cash or assets who are sort of closer to the consumption floor, are going to be very risk averse because this is their livelihoods. And so we do see overwhelmingly that farmers choose to make conservative production decisions to self-insure. So we call this a low risk, low return productivity trap. And that productivity trap is really the motivating factor behind the body of research that I'll be sharing takeaways from. So strategies to help farmers overcome weather-based risk to feel safe in being able to shift into profitable but potentially riskier decision-making. This is our roadmap for the rest of the session as a quick overview of the lessons from the evidence. We'll cover sort of the structure of insurance, why there's low demand for index insurance without subsidies, but some of its benefits and why there's a body of evidence on strategies to overcome that low demand, before looking forward on innovations within index insurance and financial protection, complementary risk mitigating strategies, and how to think about all of this within the context of climate change. Here, okay. Again, I think many of you in the room are familiar, so I'll try to breeze through this, but agricultural insurance is widespread and generally compulsory or mandatory for farmers in high-income countries, and is generally highly subsidized. It's typically indemnity-based, meaning that farmers are paid back for their recorded crop losses, usually by agents like going to individual farms to verify their losses after an adverse weather event. This type of insurance is not at all common in low and middle income countries for a variety of reasons. There's a large number of farmers who have very small land holdings, often at far geographical distances from lenders or from each other. And there's a lack of road infrastructure to reach farmers and poor regulatory environments. So index insurance has been an innovation that was developed to reach these many small, scattered farmers in LMICs by basing payouts instead on an easily observable variable or an index, such as rainfall at a local weather station, which is then compared against historical norms and used as a sliding scale index of farmers' anticipated crop losses. One sort of overarching drawback to an index insurance model is basis risk, or the risk that the index, the basis for the payout, isn't accurately reflecting farmers' actual losses. And so this means that index insurance can be characterized as a partial insurance. Farmers know that it might not completely cover their losses. And so I think that's one thing that's important to think about as we move forward. There's trade-offs between the accuracy of the index and increasing the complexity of the product versus having a simpler product, but potentially less accurate. So for example, weather index insurance often uses rainfall measured through weather stations that are more visible or trustworthy for farmers, but they may be more scattered. There's not a very high density of those in some regions, so they may be less accurate. There's index insurance based on satellite data that might be, particularly as that's becoming more available, technological advances and less expensive, might be more accurate, but there are trust concerns there. We actually had a conversation recently with an official from a government agency in East Africa who was, we were chatting with them about their decisions on which type of index to move forward with, specifically for crop insurance for farmers. And he described trying to have his mother understand what satellite insurance was, or satellite index was. It's like, it did not go well. I tried to explain to her that there's these, huge revolving things in the sky, taking pictures of her farm. It's like, no, what are you talking about? Like, I'm not gonna get a payout from that. Like, I don't trust that. And so he sort of laughed that off, but said, no, we didn't end up moving forward with satellite insurance or satellite index insurance because we didn't think that farmers would go for it. So I'll just say it's tricky to get an accurate index. But I'll go, just for visual folks in the room, a simplified visual here of how the index may work under an example of a drought. So farmers can choose to insure a portion or all of their land and take up multiple contracts. See the rainfall on the x-axis here. As it increases to the right-hand side, there would be like no or little payout, and then as rainfall is decreasing to the left-hand side, your index payout is going to increase until you hit this bar here, what we call a max payout, that purely based on these weather realizations could anticipate farmers losing all of their crops at. So if the drought is severe enough that you'll get total crop loss, you get the full payout. Less than that, you get increasingly less of a payout. And of course, this is also not looking at sort of all of the other factors that we know go into farming. It's only taking into account rainfall. I'll quickly note there's sort of a similar structure this is for crop insurance, but index-based livestock insurance, or IBLI, exists as well, where payouts are typically pegged to measurements of forage conditions that animals need to survive, rather than directly looking at like health of herds or animals. But those are often made via satellite data or vegetation coverage to drive an index of forage availability. This is more rainfall for the crops themselves. Okay. And then again, for the visual learners, a quick overview of what basis risk looks like. Two farms covered by one weather station. The weather station is recording this realization of rain. Farm 2 is not getting it. Farm 1 is, say it's a drought condition. If farm 2 has a crop loss, the weather station would not pick up on that and would not potentially reward that farmer. So there has been, over the past nearly 2 decades, many impact evaluations of index insurance. So we recently updated a synthesis product, a JPAL policy insight, that reviewed 23 randomized evaluations spanning 11 countries on common interventions to boost farmers' risk protection and help them make optimal farming decisions. Top line takeaway, general consensus, farmers have really low demand for index insurance at market prices in most contexts. Typically, it's provided with sort of some level of subsidy, getting nods from folks in the room here, some level of subsidy to boost take-up, and when it is, we see that farmers do update their decision-making to be more risk-tolerant. So we see that insurance has these important gains. What are some strategies that we can take to beyond or in addition to subsidies to boost farmers' learning, trust, etc. in taking up insurance? I'll first just briefly overview the gains from insurance themselves. So having insurance in 7 studies when it was offered at free or low cost incentivized farmers to shift their production decisions towards higher risk and higher reward choices. In one study in Andhra Pradesh, India, researchers tested offering a similar level of a cash grant and subsidy to cover insurance for farmers. And so while all farmers received a similar level of subsidy, providing it in the form of insurance versus just straight cash ended up being more effective in nudging farmers' decision-making to be more risk-tolerant. Specifically, in this example, they were 12% more likely to plant weather-sensitive cash crops than the comparison group that just got the plain cash grant. And then there are other examples in which we think that having insurance helps farmers feel comfortable in buying fertilizer, investing more in inputs upfront. And then a study in Kenya looked at livestock insurance after a 2011 drought, and 88% of households who were offered a coupon to buy insurance did. There was under 20%. This was a newer product at the time, and there was like very low take-up amongst households who were not offered the coupon. But among households who did have the index-based livestock insurance, wealthier households were less likely to have to sell off assets, so to have to sell off livestock after the drought to cope with the shock. And poorer households who previously reported having to decrease their consumption, like skipping meals or not paying school fees for their kids, reported being less likely to do so. And I think these 2 examples are nice together because they demonstrate why insurance is a compelling strategy to boost farmers' profits. There's the ex-ante or the pre-shock behavioral changes that can help farmers out of this productivity trap, as well as providing a safety net after a shock if one does occur. So those ex-post protection, leading to benefits in both good and bad weather years. So I'll keep this sort of benefits in mind as I transition to some of our sort of less exciting or good evidence on this, because there are some very difficult hurdles to overcome, because there are really many valid reasons why farmers choose to not purchase insurance. One, it's a hard product to learn about. It's not like a loan where you get money up front and then have to pay it back over time. You have to put your money out first and then trust in the institution, in the lender, to pay you back after time has passed. And there's an irregular benefit realization. So you're only getting this tangible payout in bad weather years. In a good weather year, you're not actually seeing a physical return on your investment. I know I hate paying my insurance payouts. You hope to never have to make good on them. It's something that, we in high-income countries are mandated to do, but it's definitely not an attractive payment to make every month to see that come out of your bank account. And then I think in addition to that, it just is a difficult financial product, and financial literacy is hard. In that same conversation with the government official in East Africa, it's like, yeah, people in our apartment, like well-educated folks, well-versed in these products, working with farmers, they don't understand what we're trying to do. They're not always on board with insurance. It's hard to get them on board. So you can imagine if this government official is having trouble getting his own colleagues on board, the sort of learning and trust difficulties of getting rural farmers on board as well. And then we'll go into as well the upfront cost structure and lack of capital that farmers may face. Okay, so how do we go about overcoming these? Providing information to boost farmers' understanding and trust in insurance can increase or has increased farmers' take-up of insurance in some cases. In the 3 studies we looked at where insured farmers did receive a payout or saw that their local farmers received a payout, so their insured peers, they were more likely to trust in the benefits of insurance and to purchase it in later years. But these impacts, as we may imagine, were concentrated among households with higher levels of financial literacy, and they also were easily reversed by, like, then in later years, not receiving a payout themselves. So they're easily like changeable. Offering trainings, so formal trainings, can help like institutionalize these learnings, but they're expensive. So in Gujarat, India, researchers evaluated the impact of providing specifically financial literacy education alongside various low-touch marketing strategies to small-scale farmers on their demand for a rainfall index insurance. And the financial education training was 2 3-hour in-person sessions led by the local NGO. And then there were sort of a set of other sort of lower touch, cheaper options. There were only significant increases in purchases amongst the households that were invited to the financial literacy program. They were about 5 percentage points more likely to purchase insurance, but it was actually more expensive to run that education program than to just offer the insurance. So it wasn't financially feasible for the NGO in the long term. And then finally, instead of using agents through the insurance company to market or share information about insurance, leveraging peer groups or informal trusted community agents to market it can be a helpful way to boost farmers' trust. In an example in Ethiopia, informing community leaders about how index insurance works, about how it's trustworthy and the company is trustworthy, and encouraging those community leaders to share that new knowledge with members of their IDIR or their sort of local community helped to boost take-up. There were sort of small impacts, but we'll dive a bit more into that study in a moment. Another strategy is to bundle together insurance with credit. So thinking back, insurance is an upfront purchase at the beginning of the season. I mentioned that farmers, as you all know, typically only get payouts once or twice a year at harvest time, and insurance is just another investment that they have to decide to make with limited capital, and they may not have the capital on hand to be able to purchase policies at the beginning of the season. And so there's been sort of studies on attempting to overcome cash constraints by pairing together or bundling insurance and credit products, but there's been mixed results. One, it's really hard to structure products that are attractive to both the farmers and to the lenders. In that same example I just mentioned in Ethiopia about marketing via trusted community agents, researchers also tested trying to do an IOU, or like a delayed repayment model, that was successful in boosting take-up from, as you see, 8 to 24%, but there were really high default rates in some of the community groups, which can make this sort of financially infeasible for the lender, just make it unattractive because that's an additional risk. I'll end with a bit of positive evidence. When there is a secure relationship between the lender and the farmer, bundling credit and insurance has worked. So this study demonstrated that credit is, even though there aren't very many of these products out there that have been evaluated, this study showed that credit constraints are very real for farmers because they tested under a contract farming scheme in which, again, the farmers were working with the lenders as the sort of owners of the contract, and tested offering a 30% subsidy for insurance, offering it at market prices, or offering a delayed repayment model, and even more where they didn't have to pay it back until after harvest time. And even more so than, or just as much as the subsidy treatment arm, farmers that just had the delayed repayment boosted their take up from a baseline of 5% to 72%. So there were huge increases. But again, this is contract farming is not like super widespread across all contexts. It's sort of a unique model, but just demonstrating sort of the viability of credit constraints here. That's sort of the evidence review of index insurance and where we're at with it. Farmers don't take it up at market prices. They do when there are subsidies. There's sort of partially ways to overcome low take up through savings, credit, learning, trust, and learning constraints. But there's also, because of all of the sort of benefits of insurance, there's a number of options on the table that make continued effort and research into insurance an attractive option for implementers and policymakers. Technological innovations in recent years have huge potential for reducing the basis risk that we talked about. Higher resolution satellite imagery can pick up variations in weather realizations across smaller and smaller plots. And then changes in technology use by farmers themselves and growing digital accessibility are enabling more fundamental changes in product design. One example that we were chatting about in the room before I think the online folks joined is picture-based insurance, in which a simple model is that farmers are just taking pictures with their phones of a same field at different parts or different points in the season to really quickly and cheaply verify losses. And you can imagine that this also comes with the advantage of potentially really straightforward add-ons like tailored agricultural extension using those pictures because there's more data going back and forth. And there are ongoing evaluations that we can chat about as well. But we don't have, or we don't in the evidence review have results from those studies out yet. Excited to update it with those. In addition, not necessarily changing the structure, but looking back at the example where there were benefits of offering the subsidy in the form of an insurance grant versus just a plain cash grant, overcoming that productivity trap is a strong case for insurance as social protection. So a strategy to have insurance be considered a targeted cash transfer to push farmers out of the productivity trap. So rethinking it not necessarily as a standalone marketed product in all cases, if that's a policy tool that states are able or choose to use. And then additionally, there's been recent and promising research on sort of newer types of financial product design that are also intended to get at that ex ante and ex post benefits that insurance provides. One example here, in flood-prone areas of Bangladesh, researchers partnered with BRAC to evaluate a new guaranteed credit product that was being rolled out at some existing BRAC branches. So this is a trusted nonprofit in the area. Communities were already familiar with it because they were existing customers of their other loan products. And in the study, farming households were informed that they would be eligible to receive a loan product if a flood occurred later in that season in their area. And researchers found that households who received regular information and reminders about the guarantee of protection without having to do anything about it before a flood happened, dedicated more upfront resources to agriculture. And this study is relatively recent, still a working paper, but as of now, I believe there were no like branch closures or anything like that amongst the BRAC offices that offered this product. So it has shown so far to be a financially viable option for the lender. And then everything that we mentioned sort of throughout this section and within insurance, even in changing up the structure of the product design a bit, I'll note that, of course, these are intended to protect farmers after a shock occurs, but they're not sort of changing the practice. It's not an agricultural technology itself, but there are complementary risk protection strategies that are intended to make agriculture itself more risk reducing. So 2 examples of this are evaluations of flood and saline resistant seed varieties that don't cause a yield penalty in normal or good weather years. So they're not going to be lower yielding than the varieties that farmers are already using, but they can stabilize or increase yields in bad years compared to the existing seed varieties that farmers are using. And these studies have shown that they are effective in crowding in other productive investments. In the interest of time, I'm not going to dive into those examples, but I'll just note here that the results are really promising, and the government in India is actively scaling up the rollout of Swarna. But while there are some examples of drought-tolerant maize varieties in Africa and sort of other varieties of improved seeds, a 2022 review paper from development economists Tavneet Suri and Chris Udry called for more and longer-term investments in research and development for agricultural technologies in Africa specifically. I thought a really compelling statistic is that public spending per farmer on R&D for agriculture in Africa is 2 orders of magnitude lower than in high-income countries. They cited a statistic that estimates that per farmer spending on R&D across the continent, so lots of sort of regional variation, but top level R&D spending is about $50 US or less per farmer since 1990, compared to, they called out Brazil, in which per farmer spending was $1,200 in 2000. And so this low rate of R&D means that there are less right fit technologies or ones that are tailored to local conditions. So there aren't as many seed varieties that can overcome the high level of spatial heterogeneity in African agriculture. And so while there are these like very promising results in ongoing studies of some drought tolerant varieties, more R&D is needed to gain these types of innovations for complementary risk protection strategies. But there is emerging research as well. I'll cover this sort of one last innovation, and this is a preview as well. I'm not sure if my colleague Jenna Foley at the Center for Effective Global Action is on the line, but she'll be moderating a session on Thursday with researchers on weather forecasts and remote sensing, and some of those are actually cited in the paper here on promising results of very recent research on long-run forecasts of monsoon timing that changed how farmers made investments, and helping them to reallocate resources at the beginning of the season according to these long-range weather predictions. The paper, the preliminary working paper came out just in January, so there aren't sort of public insights yet on increases in profits, but the preliminary results found that having access to relatively high accuracy monsoon forecasts allowed farmers to invest in cash crops and increase their input expenditures when they were shown that there would be sort of good forecasts over the course of the season. And then they cultivated less land when they saw that there was going to be a bad weather forecast over the course of the season. So that is sort of some exciting research coming out so far on a newer innovation that can also help farmers plan for to mitigate the risk that they face. Oops. Okay. This is a recap on what we talked about today. If you wanted to condense it all into one slide, if we don't have any way to protect small-scale farmers from risk, they're going to engage in a low-risk, low-return poverty trap. Benefits of insurance are strong enough that there's these large set of learnings on how to overcome trust and credit constraints. And I think it's particularly important as we talk about the innovations to call back to these learnings on, we'll say, sort of the first stage of index insurance products. And even as the design of them is innovated on and there's technological advances, learning trust and credit constraints will still bind for farmers. And so I think there was a question earlier today about how to sort of keep learnings as we move forward with new technologies. And I think this is where this research is really valuable. Noting as well that insurance and financial products protect from the effects of a shock after it's happened. They don't make agriculture itself more risk reducing, and so potentially climate mitigation and adaptation strategies as weather risk is becoming more prevalent and unpredictable are going to be needed to sort of bundle together mitigating and adaptation strategies, the financial protection with the actual risk reducing technologies as they're being innovated upon. I think I'll skip over this because we left a lot of questions within the presentation and we're basically out of time. We might have time for one or two questions. Apologies for the late start in our sort of technology issues earlier. I'm also happy to chat during the coffee breaks, or I'll leave, my email is on the screen as well if anyone online wants to follow up. But thanks so much for joining today.
Thank you. I think that point about the lack of demand for the standalone product is spot on. In Syngenta, we do this kind of stuff. It's called AgriClimb, and it is well accepted, and we run a lot of product through it now. But it's always what we call a product plus approach, where it's part of like a loyalty program that you get access to because you're buying our stuff. And so instead of spending, X% of the marketing budget in, conventional publicity, we just use that same money to pay the premiums for these sorts of things. So we offer it to them for free, and it provides them a mechanism for being a little bit more expansive in investing in crop inputs. So it works for them because, like you said, they're very risk averse, because if they have one really bad year in which they really invested heavily, they're done. So yeah, I can see how that's a challenge. When you have something else going on with them, then you can make it work.
Exactly, yeah, the bundling of services or products together is a compelling case. Thanks for that comment. Okay. I know we have to clear out the room for the two. Yeah,
there's the next one at 2:30, so I think we're good, but thank you for that. And no questions from the chat, so
okay.
Connect with you as well.
Yeah, definitely.